Very excited to be here. As you've heard from a number of other speakers, there's a lot to talk about. We're focusing on the various subjects that our panelists are experts on: finance, development, affordable housing, interest rates, foreign exchange issues, and so on and so forth. This is a very broad subject on a very, very big continent as well. Obviously, 54 countries. There are countries on that continent that are in every single point of the spectrum in terms of development, in terms of political stability, and other. We're not allowed to talk about challenges necessarily, but obviously investing in Africa, these are some of the subjects that we need to discuss. So the subject is transforming reality, the future of investment and development, and ways to realize Africa's fullest potential. It is an extremely broad topic. We only have 45 minutes, but we have some excellent panelists here, as I say. And so I think what I'll do is I'll jump straight into the questions. We will open questions up to the floor at some stage later on during the discussion, and then go back to the panelists, and I will nominate panelists, or they can volunteer to answer any of your questions out there. It's very difficult to see you with the lighting, but I'm sure we'll be able to see those hands raised when we get to that stage. So if I can jump straight in, and I'll start with a very broad question, and this question is to you, Mohamed, to start off with. Which African countries are demonstrating strong momentum in real estate development, and what are the key drivers that contribute to their success? So where is this development happening most, do you think, in your opinion, and why?
Thank you, Ben, for the question. So let's put some numbers first. So today Africa has a deficit of approximately 60 million units. And by 2030, if the trends remains, it could reach 130 million units deficit. So this is a big challenge for local governments, but at the same time, it's a great opportunity for us as developers. So the countries that present the best momentum in terms of real estate in our continent are the countries that have strong infrastructure, that have FX and politically stable, and they are politically stable. There are countries that have also housing deficits. So these are the main important factors that give strong momentum. So for me, the countries that have these ingredients are definitely Egypt, with a very big population, an important deficit, strong diasporas, because also diasporas invest a lot in their home country. We have Kenya as well, that have the same characteristics. We have Morocco, that same has strong infrastructure, big diaspora that are willing to invest back home.
So diaspora and remittances, I mean, you can run into millions and millions of dollars, often having a big impact on GDP. So you see this as an important driver for real estate development in Africa. You see those remittances as typically going into real estate development in particular.
It is definitely very important. Just to give you a couple of figures, in Morocco, it can represent 30% of the buyers in the real estate industry. In Ivory Coast, it's even higher, around 40%. In Senegal as well. So they are really big players in real estate. So diaspora make the markets, because they have, of course, the purchasing power as well. So yes, I was saying that, and of course, other countries like, of course, Nigeria. If you see Lagos with more than 20 million population and a very dynamic economy. We have Ivory Coast also that present also huge opportunities. Ivory Coast is a little hub of the Western African region, so it attracts a lot of a lot of the investors that want to invest in real estate. We have people from Mali, from Burkina Faso, from Guinea that invest in Ivory Coast because it's a secure and very interesting market.
So it's really those countries that are still relatively nascent, but they're now on that growth trajectory where you're seeing most of that real estate development happening.
The growth, I see them in these countries. So again, Ivory Coast, Morocco, Egypt, where you have this environment that offers plenty of opportunity.
Sure. Any other thoughts from the other panelists before we move on that topic particularly? I think we've heard a lot about this housing deficit. You talked about 60 million units rising to double that. We've heard the number 51 million bandied around quite a lot. Mildred, I want to turn to you, Africa Union for Housing Finance, and this issue of affordable housing. Now, from my perspective, affordable housing, one of the biggest challenges is that developers have to make a profit. So you talk about, a 20% development profit. It's notoriously difficult to achieve that in the affordable housing sector, and generally that profit is artificially replaced either by concessions in interest rates or guaranteed takeoff or government providing free land, some sort of concession that's provided. And is that true? How do we address that affordable housing deficit in a way that the private sector can participate in? What is the solution? Is there a solution?
Well, I'm an optimist, Ben, so I always believe that when you put your mind to something, definitely there is a solution. So for those of you that perhaps don't know much about African Union for Housing Finance, we are a member-based organization. We represent various countries in Africa, and our main drive is to promote the efficiency of the housing value chain in Africa. And so part of what we're trying to solve for is what you just said, Ben, which is driving the affordable housing mandate. So we do that really in two fronts, and perhaps that will answer your question. In looking at improving the housing value chain, and improving the efficiencies in the housing value chain, we recognize that developers and financiers alone can't solve the problem. So we've created what we call the Ministerial Roundtable. And we call governments and central banks from the countries where we operate to sit in the same room with developers and private sector and to address some of the key challenges that are blocking the issues of affordable housing. So whether it's regulatory regimes that change overnight and then discourage investment into Africa, whether it's the issue of infrastructure that Mohamed just spoke about, which can make or break a housing initiative. Just a few years ago in Zambia, the company that I work for was doing an affordable housing project. It was supposed to be affordable, but however, the lack of infrastructure made the house totally unaffordable, even though it was a small two-bedroom house. So we address matters that impact the value chain with the various ministries in the countries that we operate. And secondly, we also look at how do we lobby and drive the issue of affordability. So we look at it in two sides. Number one, the supply side. So we try to influence the architecture, the design, and the materials that go into building that house to drive affordability. And we define affordability as a house where if you're paying, let's say, a mortgage or you're paying monthly, it won't go beyond 30% of your income. So that's affordable. That's how we define affordability. And so to do that, we've come up with innovation awards. So and it doesn't matter which part of the world you're from, the innovation awards are trying to drive developers to think differently about how they build and construct the house. And secondly, we have what we call a shack room. In the shark room, it doesn't matter whether you are a financer or you are a developer, you pitch your ideas to a potential set of investors. And we've seen brilliant innovations coming out from companies like Citra down in Cape Town, South Africa, where their design has reduced the building time by 75% and carbon emissions by like 50%. On the demand side, we've seen innovations coming out of First Rand Bank, South Africa, that came up with a group mortgage. Again, we've noticed that the mortgage penetration rate is very low, and this is because across the continent, interest rates are really high, mostly double-digit, driving towards 20%, and this inhibits the growth of the affordable housing. So we've seen FNB coming up with a product that works in such a way that a group comes together and is able to get financing. We've also seen some innovation coming out of the company that I work for, where we've partnered with Habitat for Humanity, and we've managed to come up with a model where we can underwrite the informal sector. And again, why is this important? We noted when you look at the numbers, yes, affordable housing, the affordable housing gap is around 51 million, most of which is sitting in the informal sector. So if we're going to unlock affordable housing, we need a way to make people that are in the informal sector be able to access financing at an affordable rate. So we are currently working on a model, a credit underwriting model, where we unlock the informal housing sector. And so far, 2 months later, more than 2,000 people have been able to benefit using this particular product. So that's some of the innovation that we're seeing to drive and unlock the issue of affordable housing.
Innovation definitely seems to be the answer, whether it's innovative ways of reducing the cost of construction or innovative ways of getting the purchasers access to finance. I think mortgage penetration is a huge issue, as you say, across the continent. When I left Kenya in 2022, I think there were less than 30,000 mortgages in a country with a population of almost 50 million people. Shocking, really, that it is so hard. Niyi, this wasn't a question for you, but I think the mortgage issue is so important. As the head of real estate finance, I think you're extremely well placed to give your views on mortgage penetration on the continent, and particularly the challenges that are faced with at the lower end of the scale. What's your opinion on that?
Thanks, Ben.
I don't mean to throw you under the bus.
No, I'm good. I think Mildred has kind of made the point. I think the challenge with affordable housing in the continent boils down to the interest rates. You talked about Kenya. I think Kenya is about under 50,000 mortgages. Nigeria, with the population of 200 million, is under 100,000 mortgages, just about. And most of those mortgages are, people that work in financial institutions that get some sort of rebate for doing that. So the rates are somewhat related to the macroeconomic environment of each of those countries. Kenya is probably ahead of the curve, but I think it is ahead of the curve in terms of where rates are compared to other sort of emerging African economies where rates are more towards the high double digits. Kenya, it's kind of low double digits, which is achievable. I think in the Kenya's reality, I think there's a bit more of a demographic preference that drives that a bit. If you think about cost of living in Kenya, the kind of products available for mortgages are more multi-family housing, which culturally a lot of people tend to not prefer, at least in the case of Nairobi. And that probably influences the uptake of mortgage. But ultimately, to what Mildred has said, it's down to what the rates are.
So what about the paradox between governments who have legislation in place to protect homeowners from being evicted from their properties, and the fact that very legislation is in part responsible for higher mortgage rates because the lenders are not able to repossess properties where mortgagees default. I mean, from my perspective, having seen this in Africa, if we were able to change that legislation to reduce that level of protection, what you'd actually be doing is make mortgages much more affordable and available to a wider percentage of the population. Is that a challenge that you see, or is it more financial?
I think that challenge is there, but I think the impact of that on affordable mortgages is much less serious. If you think about the MRCs, that's mortgage refinance companies, that's a platform sponsored by World Bank, IFC. They're present in Kenya, they're present in Tanzania, they're present in Nigeria and a few other sort of African countries. What those entities have done is they found a way to standardize mortgage offering and mortgage products. So whilst the protection for defaulting tenants, defaulting occupiers is there, the real challenge is really around, one, the affordability of the product itself, but more importantly, the rate of the mortgage rates that eliminate a wide part of the population from being able to access mortgages. And that's what needs to be fixed, actually.
Sure. Okay, thank you. And Nabil, Executive Director of Shelter Afrique, I mean, interest rates, obviously an issue with you. My question for you is, several African currencies facing high domestic interest rates. How can development banks balance affordability for end users with the cost of capital for investors? I mean, more of the same thing, really. What's your opinion on that?
Yeah, thank you. Thank you. So the problem, I think, it comes first from currencies. Because affordable houses and houses in general is in need of local currencies more than hard currencies. We are speaking about around 1.4. Our estimation is maybe 1.5 trillion USD. But in which currencies? So if we look to the need of investment and the need of housing in Africa in local currency, that means we have to look to the local African local currencies. Of course, there is many challenges. And we know that many African currencies now have double-digit interest rate, 20 and 25. So this is make affordability of the housing very hard to make it. So I think we have to see how we can finance it. Of course, not directly from the local currency, but how we can bring the hard currencies like USDs to the continent, and by this we bring investment amounts, but also we can reduce the local currency by this hard currency investment. So we at Shelter Afrique, we explore many ways, and especially when we approach investors, hard currency investors, we propose to them that there is a mechanism to hedge the FX risk, and this is especially by our counterparties, commercial banks in Africa. So we propose to commercial banks investment in USD against facilities in local currencies. And there is a spread in deposit and in investment in USD between the market and the interest rate that we get it from bonds and Euro bonds governments, that we include this spread to reduce the local currency cost. So by this way, we can get local currencies cost even at government bonds and TT rates minus something like 3-4% sometimes. And this can help us to reduce the cost of local currencies.
So going back to my own personal experience of running Knight Frank's business in Kenya, we saw a delta of almost 100% between financing in USD and financing in Kenya shillings. Interest rates, 14-15% would be more like 7 if a project was funded in Kenya shillings versus US dollars. the biggest challenge would be obviously the income has to match the loan repayments. So you're looking for a dollarized income, so that's tenants paying in USD. And obviously in some markets that's easier to achieve than others. The classic situation is developing a shopping center whereby the whole mall is dollarized, but of course your line shops are earning income in the local currency. So any currency devaluation effectively means a rental increase for those tenants. I mean, how do you get around challenges like that?
No, we don't get any FX risk on that first.
Yeah.
Because for us, it isn't, we saw some challenges with FX markets, and we have the last one from 2022 in Nigeria. So the FX risk is a must to manage and especially to hedge it. So what we propose that there is, you see for, and I repeat, for especially with local banks, so we operate in assets liability. That means that we propose to them investment in USD, and this is they increase their liabilities in USD. They can use that for their activities to lend to customers or to invest in euro bonds, in euro African government bonds, and in the same time we can get from them the local currencies loans. So this structure, it's something like it's the same like rollover swap, but it can operate in balance sheet, and then we increase their loan books, and this is for them something like the banks and commercial banks, they like to increase their good loan books, and by the same way they get financing and they get long-term resources in USD. So this structure helps us to first avoid the FX risk, because here we can get the local currencies without taking any FX risk. But at the same time, we help them to increase their balance sheet and their resources in USD for long term.
Okay, thank you very much. Okay, let's switch this up slightly. Niyi, I have a separate question for you. Talking about capital sources, both domestic and international, obviously driving real estate growth in different African regions. So where's that money coming from? Where is the capital being invested, and how can it be improved?
Thanks. So if you look at the trajectory of the commercial real estate markets in the continent, and obviously I think we've said it, but the continent is not homogeneous. You found that initial development capital was coming through from a lot of the international private equity entities, and they funded quite a bit of the investment-grade properties across many markets.
But private equity has a fairly short-term horizon typically. How does that match with real estate, which is obviously a very long-term play?
Hence they failed, or not failed, but I mean they've been under stress because the exits then have not panned out the way they anticipated. I think that was obviously interrupted by COVID and similar realities. What we're seeing now is an emergence of domestic capital sources. So you're looking at pension funds from a number of the key jurisdictions. Botswana has a huge amount of pension that is generated that is surplus to its domestic needs. You see the same in South Africa. That is also emerging in Nigeria, if I talk about sub-Saharan Africa, and partly Ghana.
So you're saying private equity comes in, does the real estate development, has a relatively short-term exit, and then the pension funds with the much longer term tend to mop up to purchase properties from PE?
So that's what you're seeing at the point, but what is perhaps more sustainable is those participants getting involved much earlier in the process than they used to. And perhaps it's a more sustainable source of capital to development in the market. I think the domestic markets have to drive the activity. There's a better appreciation and understanding of the challenges. And with that sort of mobilization, perhaps you start to see greater sort of participation of international, the more appropriate, stable international capital sources in the market. I think it was 2019 that was recorded that more than $4 billion left South Africa to invest in property outside of South Africa. And you will see, I think...
Was that pension fund money?
Pension fund money, exactly.
Yeah.
I think Boniface sort of highlighted to that as well, to see that cross-border investments. So you're seeing a lot of pension funds mobilize capital, primarily for domestic investments in the markets, but there's now an opportunity for them to actually deploy cross-border across the continent itself.
Interesting, yeah. I mean, from the time that I spent in Tanzania, we could see that although typically not a particularly wealthy country, the local pension funds are actually relatively wealthy because they deduct contributions at source and sometimes fairly hefty contributions as well. So it's good to see over time that those pension funds are actually beginning to become competent developers themselves, not just within their own markets, but then looking for opportunities beyond, like for instance, PIC in South Africa investing in Botswana and other places like that as well.
100%. The other segment that I think is evolving and is very critical is family offices. Real estate is not a well understood segment. Most prefer the more sort of predictable markets or sectors. And you need quite a bit of specialization. So you find that the liquidity is there or the capital is there, but people tend to avoid that segment. But you're starting to see some of the family offices as well as the pension funds trying to sort of deploy more capital into that market segment because there's a matching between their liability profile and the life of the assets in a manner that you won't probably get with any other sort of investment segments.
Interesting, yes. I think family offices are definitely becoming more important as players in the real estate sector. Knight Frank generally has seen, not just in Africa but elsewhere in the world, family offices move from residential development into much more commercial development and then start competing with private equity as well. So it's interesting to see that we're seeing that across the continent. Mohamed, if I can go back to you, talking about Africa and the challenges that we face in the real estate sector, what would you say the primary obstacles were hindering the continent's full potential in terms of real estate development?
That's a good question, Ben. So, of course, it's clearly an opportunity to invest in real estate, because when we talk about the deficit, but at the same time, the execution is a hurdle. It's a challenge. So for me, the biggest obstacles are first the finance. We were talking about it. So both for the developer, but also for the buyers. So for the developers, again,
cost of capital.
Cost of capital is really high and complicated. So that's the first obstacle. The second one is the cost of production. So most of the goods are imported, so you have to pay the transportation, sometimes the customs and the logistics. And because the lack of local industries, so it makes it harder. Just to give you a small number, we operate in Morocco and in West Africa. The cost of construction for affordable housing in Morocco is 50% cheaper than in West Africa. Mm. So, for example, just to give you a number, the construction cost in Morocco is around 200 euros or $200 US, and in West Africa it's 320 in Côte d'Ivoire or in Senegal. So this is a major obstacle.
And that's why is that?
Because again, the importation of the goods.
So presumably over time, those countries where it's more expensive, those prices will come down as they start to produce the raw materials themselves within their own markets. It's just a question of development over time.
So the importation, also the low productivity, because the workers are not well trained. Also the productivity plays a major role on the cost. Another obstacle is the FX and the political situation also. The infrastructure again. Sometimes when you do a project, access to water, to electricity is really far. So to get connected to that makes it high in terms of investments.
What about recourse to the law, title issues, that kind of thing?
And of course, title issues. So most of the land are not titled. And when they are titled, sometimes we have contests from other people. They say, okay, no, this is not your title, it's mine. So this is a major challenge as well. To get the licenses, it's very slow also. So, and you know, real estate, it's about time. The faster you go, the better you can propose the product at the right price. So for me, these are the major obstacles. But again, if you can handle all of that, and you can, it's a very good place to make investments.
So I mean, if you were an investor looking at Africa, looking at these high returns, and you wanted to invest in Africa, you haven't done so before, what would be the best way for you to avoid the pitfalls, the challenges, and the Africa risk, as we call it? How would you go about that?
For me, there are 2 or 3 major ingredients. First, you need to have to make the project very effective, and to do in terms of engineering, to look at it very sharply. So this is very important. Second thing is to have incentives with the local governments, so that you can have free customs. That's really important. And third, if you can have also contractors that you work with, that they can bring you a good price in terms of construction costs.
So you're talking about government participation. You want to look for a country where the government is proactive in encouraging foreign investments, perhaps with tax incentives, special economic zones, those kinds of things to encourage foreign investment. Are we seeing more of that happening on the continent?
It is happening in Morocco. It's happening a lot. So we can address affordable housing at 25,000 euro per unit, which is really low. To compare, in Ivory Coast is around 42,000. So because of the construction costs that are really higher in Ivory Coast.
So it's more expensive where it's needed most. That's basically what you're saying.
Definitely, and the incentives as well are not as interesting as, for instance, in Morocco. So we really have to look at countries where we have these incentives with the governments, and the security of the land also is important. And again, the financing also is a major challenge.
Okay, I mean, Mildred, we keep coming back to affordable housing, and it is such a big challenge, such a big issue on the continent. As the Vice Chairperson of AUHF, you know, what can you share some of the interesting things that your members are doing to advance residential real estate on the continent? I mean, what are they doing that's addressing these issues?
All right. And before I go to perhaps what some of the members are doing, I just wanted to add on.
Please.
Yes, I think what Mohamed was saying. So if you are an investor looking to come into Africa, as African Union for Housing Finance, we provide data, and it's all free. So every year we produce what is called a yearbook. In the yearbook, you will find data on 23 countries on the landscape for housing in those particular countries where we operate. And you can find this data on the AUHF website. And why is that important? It will help you make more informed decisions. And I know that there's so many risks in Africa, but I also believe the opportunities are good. So you need to know the risk landscape in the countries that you are potentially looking at entering, and we provide you that data. Secondly, the AUHF will provide you networking opportunities. So when you're part of AUHF, for instance, if you're going to say, I want to go into Nigeria or Zimbabwe or South Africa, but I don't know where to start, AUHF is a great place to start. Reason being, we will give you networks and linkages into those countries, not just from a private sector point of view, but also from a government point of view. One of the, some of the innovations, speaking to you, Ben, that we have seen for affordable housing that has actually worked is where you partner with existing local entities in those countries. Why? They understand their landscape, they understand their risk. We have seen that countries where some private developers that don't fully understand the markets that they enter, you find that the time to sell is far much longer. So you find that across the continents, you've got projects that people have poured capital into, but it takes a long time for them to sell those particular assets. And really, we see the gap in not understanding the context, the market, what is affordable in that particular.
So the definition of what is affordable housing obviously must vary from country to country because everybody's at a different stage of the growth and development.
Absolutely. So you need to understand context, you need to understand that country, you need to understand what is driving real estate. What type of real estate does that particular country need? And if you understand that, you'll be able to unlock affordable housing for your company. And so I was saying that some of the innovative partnerships we've noticed is where private developers go into countries, they're able to partner with governments, and we've seen governments providing land for free, and obviously then that translates into the final cost of the unit.
Of course, artificially putting that developer's profit back into the equation.
Absolutely. And again, I'll go back to when I said we have a ministerial roundtable. We've noticed a solution on the finance side itself won't solve affordability. On the supply side will not. You need the whole value chain working together. And that's where we need governments to actually come on board, whether it's providing infrastructure development, where they put it into the budget. So if you're a developer, you're able to go in and then you don't have to do the bulk services, your water, your storage, because that increases the cost of your house by more than 30% in some countries. So it's really critical for you to understand the context and understand the market.
Okay. Nabil, Shelter Afrique, what was your take on affordable housing? What can you add to the debate? I mean, how can we? I know you don't have a magic wand to solve the problem, but what are your thoughts?
Yeah, I think first, Shelter Afrique, it's really it's Pan-African government banks, so we have access to government. We discuss with them. And one of the points that we are pushing for is how central banks can help. Because and of course, the financing is one of the big barriers of affordability and not just expansion of the housing in Africa. So we are discussing with central banks how they can accept to refinance the housing sector. Mortgage penetration rate in most African countries, it's sometimes not exceed 5%.
It's almost negligible.
Banks don't give mortgage. Let's say that, and we know all of that. But this can't be without central banks' involvement in this action, because you see in different countries. For example, in Morocco, I saw in Tunisia, banks looking for mortgage because for them this is like a cake for commercial banks. But in most African countries, they don't give mortgage, especially because they don't have enough liquidity and they don't have the backup of central banks to give them liquidity when they need. And the only mechanism to give them liquidity is how they can make the refinance of let's say, the mortgage go to good book. It can be for mortgage, also for investment or for developers. So it's not just government, but I think really it's central bank.
Thank you.
Yeah, thank you.
We're getting towards the end of our session. I wanted to open up to the floor. I mean, I've really enjoyed this conversation. I hope you have too. If there are any pressing questions from the floor, please do. This is your opportunity to do so. Otherwise, if there aren't, I will go back to the panel and ask them some more questions. Unfortunately, I can't actually see if there is anybody out there who does want to ask a question. Do we have, yes, can we get a microphone too? If you could introduce yourself briefly and then just either address the panel as a whole or you can throw somebody under the bus and
Good morning.
Choose someone in particular.
I'm Mariam. I'm representing from Spectrum Architecture. This is international architecture and design company. My question is about how open is current projects for international design companies, and what will be your recommendation regarding what kind of risks we can avoid to reach Africa's region market and support with our sustainability projects?
Okay, so a sustainability investor looking to avoid risks in Africa. Who would like to take that one? Niyi, I'm going to...
I think someone said it yesterday, and Mildred sort of alluded to it as well. You've got to pick the market that you want to penetrate. And I guess there's enough data to provide some guidance as to where the attractive markets are. You've got to also find a domestic partner, which is what Mildred sort of alluded to as well. I think those two components are very critical. Boots on the ground is an imperative. You can't briefcase develop in many of the countries. You've got to be there. Engineering sustainability is not as difficult, at least in the experience that we have. There are a number of standards that you can apply, whether it's IFC Edge, LEED for projects, or Gold Star. You can build those criteria into the projects, and it's easy to. It's not difficult to implement. Even from a lender's perspective or from a financier's perspective, we give preference to projects where there is an incorporation of sustainability into it. We actually give financial rate discounts, not a massive amount, but it's something that, from a Standard Bank point of view, we do because it's in line with our own sustainability goals and the conversion of our portfolio from traditional to sustainable.
I think that's a very important point, Niyi. Thank you. So effectively, what you're saying is you have to look for the right partner in the market you're going into. You have to be aware of local legislation, availability of financial discounts for ESG compliant projects. But I think the other thing to remember is that in a lot of these markets there may not be legislation that is ESG related, but it's actually driven by the private sector itself. So if you have two buildings in a market and one of them is LEED compliant and the other is not, you'll find the best tenants will gravitate towards the one that is. So if you're looking for international occupiers, then you're going to need to be ESG compliant, even if the local legislation doesn't yet insist on it in that market. So very interesting. I think that's the key takeaway there. Do we have any other questions out there? Difficult to see. Okay, we've just got a few minutes left. I think we've got time for one more question here. Niyi, just going back to you again. What traditional property segments, in your opinion, continue to drive sector growth in the various regions? Where are you seeing which segments are most popular?
Defensive. I think when we went through, if you take the continent, again, not homogeneous, the segment that provided the most resilience is actually offices. So in the more developed economies, that took the greatest hit. But in a lot of the continent, the office segment was quite defensive. I think Mohamed sort of alluded to it. What you find, what the office assets sort of stood with, or should I say, what they created was a hub for coordination, or sorry, for collaboration. So all your infrastructural needs are somewhat sort of domiciled in that sort of office space. So you found return to work appear much faster. And that sort of collaborative needs sort of embedded in the office space.
So retail more volatile, hospitality more volatile. What about the
actually hospitality recovered quite strongly?
Yeah, fair enough. What about the industrial sector?
The industrial sector also sort of became a lot more resilient because just-in-time sort of management seemed not to have worked in the COVID scenario. So increasing the value chain, or should I say moving goods closer to the value chain, became quite important. So the demand for industrial actually kind of shot up.
The retail online disruptors driving the industrial sector?
That is part of it, but it's not as prevalent in the continent.
As it is in other parts of the world.
Exactly.
Ladies and gentlemen, we've reached the end of our session. So summary, it's a big continent, 54 different countries. They're all at different stages, but lots to think about, lots to talk about. We could be here all day talking about this, but thank you very much for giving us the time, and thank you very much to my panel for an excellent discussion. Thank you.